All right, good morning, everybody. I thought we would start this morning taking a look at some previous examples of what CPI has to offer. There is a trade possibility today that I really like. Um, I consider it a liquidity gap close play. So rather than doing what I normally do, which is trying to scroll back through the charts to show you guys, I went and got them ahead of time, and we'll just show you some failure examples and some examples where it didn't fail, so that you have a pretty good idea of the approach today and what it is that we're trying to see. The good thing is, if it's not going to work, we're pretty much going to know immediately, right? Like let me do it in an order so I don't lose track. So that's one of the best parts about this strategy, is that it rarely begins the setup and then fails to follow through. It almost always fails right at the beginning, so you'll know not even to bother trying it, or it gives you the setup and then you're good to go. In order, this is February. Let me see, make sure I'm doing this right. Yep, we got February, March, April. And the two best examples, if you want to go back and hunt for yourself, is April and May, I believe. All right, so the 8:30 candle, I got it marked in yellow where it opens. If it looks like this, where you've got long wicks on each side, the setup is void. You don't want it at that point. What we're looking for is a liquidity gap, and this isn't representing that at all. So that was February. March, same thing. Really wide candle, but wicks on both ends. The open is marked in a yellow circle. Now, we did drive away from that and come back to it and quote close the gap, but it really didn't have a gap to close, right? That's just because it did come back to that open. This is a classic example of what we're looking for today. Now, it doesn't have to be a green candle. It doesn't have to go up. It could be exactly like this, but to the downside. But you want that thing to open and drive in a single direction. There's almost no wick down here to the downside. And it's okay if you do get a little wick. We just don't want something like this where it's really big, long wicks on each side. We want something more like this. Now, this is a 5-minute chart. It's a single bar direction push, and it spent the rest of the morning trying to get that gap closed. Here's another example, 8:30. Data comes out. We get the drive. Notice it's not necessarily one big candle like this last example. Instead, it's multiple candles until the drive was done. It just kept going and going and going. And then finally it dried up, rolled over, and started headed back. And by 11 o'clock, just like with the other one, it was a done deal. Here's another example of what we don't want to see. This is June CPI. So big wicks on each side, starting and stopping very close to the same point. This is not what we want, right? It's not the droids you're looking for. And here's one example out of the entire year where we actually had the single bar push in the right direction. It started to do the fade out like everything it was supposed to do, and then it never came down and closed the gap. So this is the only failed example that I have to offer, that it actually gave us the liquidity gap candle and the setup and everything was there, and yet it did not close the gap. So it does prove the point that the only guaranteed always thing in the market is that if you slip, the market's going to take your money. That's the only promise that there is, right? You screw up, you're going to lose money, guaranteed. Nothing else is guaranteed in this game. So, CPI day, it's also a jobs day today, which, one or the other would be enough, but it's not one or the other, it's both. So we have the capacity today to really see some moves, and we have the 30-year auction today, one of my personal favorites. So it's going to be a pretty heavy day. Notice that it's green on the screen around the world. With such a large data point looming in front of us, you have to believe that the green that we are seeing is more of a reflexive bounce mean reversion and less of a drive or a push or any kind of bullish sentiment, right? Sorting these in any sort of order, Japan is leading the way at 1%, and Europe, which is still open right now, is flat on the day, no change. So Hong Kong at least is in the green. It's been a while since we've been able to say that. The small caps are kind of falling behind out of all of the US indexes that we're looking at. The Dow Jones is about 0.5%. And that's about where we're at this morning. We just need these data points to come through. We got crude down, nat gas is down, gold and silver and copper is up. So commodities kind of meets with that reflation trades discussions, right? So here on FX Street, I always recommend this place. You don't need an account here. I don't even recommend giving them an email address and signing up for the free stuff because they will just harass you in emails. You don't need to sign in. You don't need an account. And if you're new to trading, it gives you an anticipated impact gauge, right? I've had people say, well, I'm new. I don't know, which economic data points are important that I need to be concerned of and which ones that I really don't need to be concerned of. Well, this will give you that gauge. It's not a promise or a guarantee that there will be violence and volatility, but it's a good heads up so that if you don't know, it's at least telling you that historically, this particular economic event has, a history of being violent or of not showing much volatility at all. That way you get a better feel for it. We do have a lot of Fed speakers today as well. Although it kind of lands into the later part of the day and even after the market is closed with Harker on his second speech. So when it comes to seeing Fed speakers on any given day, one thing that you can do is try to dig deeper. A lot of these speeches are not market moving, right? If they're having lunch at Girl Scouts of America, anything they say there's probably not going to be market moving, right? So it might say that they're going to give a speech, but if you dig down into it, you might find A, that it's recorded, in which case it won't move the markets, or B, it might be at a venue that, doesn't suggest any kind of policy discussion or, any real shock and awe surprise data. So again, won't move the markets. So that can save you a lot of grief, thinking, oh, this person's going to talk today at 1, maybe we'll see some movement, and then nothing happens. You wasted your time just to find out they were just at some lunch, and wasn't going to be speaking on policy anyways. So we got finance juice here. This is another one that I always recommend for multiple reasons. One, you got a filter here so you can filter out what it brings to you. This is a news aggregate source, right? It's going out and it's aggregating a collection of data. It's fetching news from different locations and bringing it to you. But not all news is equal. Some is subpar and some is just straight trash. So you can use the filter up here to weed out the things that you don't want, right? And then everything that's left is more in line with what you're looking for. It also does a really good job with these wrap ups. So when our market closes, they do a wrap. They kind of give an idea of, hey, what happened today in our markets? And before markets open, there'll be another one, right? Say like right here, morning juice, US session. Should we click on that? It's got this excerpt we can read, gives us an idea of what's on the docket for today and any kind of real big headline things that maybe we should be aware of. So that's a really nice thing. And it's not just for our market, it'll do that for the Asian markets, the European markets. This is a really great place to go. And again, it's free. You don't need an account here. You don't have to buy anything or even sign up. But I do recommend that you do sign up here so that you can save your settings, right? You don't want to have to go in every single day and change the filter. But if you have an account, you're logged in, even the free account, you can set your filter and it'll stay where it's supposed to be. Another good thing on this free site is this tick strike. It is audible only, but if the flow increases on the S&P, it will make noise. That's it. Nice and simple. You just have it in the background. If it starts making that really weird, odd noise, you know that the ticks are picking up. It's got my attention more than once. Now, free gets you what you pay for. If you had an account at Tick Strike, it would work so much better than the free one. But that doesn't mean you can't use the free one or that the free one isn't any good at all, because it's as an alert to get your attention. The free one does more than enough. It's all you need. Yeah, good morning. I said good morning. Salty. So we did find that 10-week yesterday. That very likely is the reset that we've been looking for, although we still need to get through today and the rest of the week. It wouldn't surprise if we overshoot it a little bit, say get underneath it and then come back up again. All in all, as long as we're holding above those 4 major moving averages, the market is still in a bullish trend, and that won't change no matter what you hear on the news. All right, nothing else is going to matter at the end of the day if we're still holding above these major moving averages. Now, things turn, right? Even a bullish market will turn bearish at some point, and the change starts from the inside out. So from the smallest chart time frame is where the turn begins. It has to echo out far enough, high enough for it to be recognized on the daily, the weekly, the monthly. So sure, we're above the 10 and the 20 and the 50 on multiple time frames, you know, from say the 5, the 15, 30-minute charts, hourly charts, start getting up in the daily and weekly. So we are beginning to fail in this structure, but even price action alone continues to show that we've still got a higher low, and that hasn't changed yet. So even if we do get below the 10, we would still need to get a lower high, a closed lower high on the week to even begin to consider that we're failing and that we, you know, might begin to start heading to the downside. Otherwise, this is just a good needed pullback on the year, because it's been a pretty good year, right? From 3,800 to 4,600, not too shabby. As you would anticipate on a day like this, the volume is really light in the overnight hours, or less than 100. That makes sense. They're sitting out waiting for the CPI numbers. And we do have market maker move this morning. We can see the 3M up here in that bright pink. The 3M market maker move shows us that they are hedging in the front end, that they are actually trading options on the futures as a part of that hedging process. We know that because it's the options that are being looked at to gauge if there is a market maker move at all and how big the market maker move is, right? So we know it's in the options. It's right here. And that will show up when the front series has a higher number than the next series out. So it's reading these option data points. And if that is true, we get a market maker move. We won't get it if that's not true, right? If If the front isn't higher than the back, there won't be a market maker move. So they're hedging in the front end of the options. That's what caused the market maker move. The lows in the last 2 days have been perfect in the ADR. So not necessarily on the ES, but in the SPY. The turning point yesterday and the day before were both at this yellow line down here. So every day, talk about what the ADR is. 21-day ADR up here, 0.95. It's about a $42.50 move. It lines up with this red line down here and this yellow line down here. Those are the ADR levels. We got ADR to the downside, and then we have ADR to the upside. And it's not anything special, right? It's just math. We're looking at a 21-day average, how far the market moved from its highest point to its lowest point in one given day, and then looking at the next day and the next day and the next day, doing that 21 times, and then dividing it by 21, right? Adding them all up, divide by 21, you get your average. That's these prints, right? And there's a lot of stuff on here, so it can be perhaps a little hard to see sometimes. Turn some of this off. We're still underneath the weekly pivot. We're still underneath, or we're interacting with our daily pivot. All right, that's a little better. We'll even get rid of the voodoos. Well, you can't miss that. So in the last 2 days in the SPY, price has come down and hit that yellow line. And that's been the stopping point. Yesterday, in fact, the NASDAQ got there first, tried to rally up off of it, but the S&P had not yet got there. And the NASDAQ fell back to it right about the same time that the S&P finally did get there. And then they both turned together and started working up off of that low. So these levels, you know, like I said, there's no magic to it. It's just math. It's just the average. The people just do what's comfortable, right? They'll run the same thing that they've been getting. They'll do the same thing that they've been doing. They'll buy in the same areas, whether it's, you know, in the money, at the money, out of the money. They'll sell in the same areas. So optionality has a large part to do with what's going on a day-to-day basis. Gamma levels, all of that stuff. It's a big puzzle with a bunch of pieces in it. So it's not a surprise that we come down and we hit an exact measured spot, right? Like a average move. Today, the average move is landing on an even more important number. 4450 is a significant level that we've come to multiple times. If you go to Trading Ticks and places like that, they'll talk about how much gamma is here, whether it's a 0 gamma level or not, a major turning point, major key level in optionality. So if we get down there again today, very likely, you know, at some point, how do they say it? If you keep kicking the door, at some point it's going to open up. Persistence beats resistance. But it's the spot we want to keep our eye on, right? So on a day like today, with the market maker move, this yellow line down here is only covering what our average move is. We now also want to add the market maker move to that. So $43 just to round up, and then another $17 is a total of a $60 move in a single direction in the S&P. Well, that's not too hard to do, right? From where we closed yesterday, we just measure 60 something dollars in one direction. Or from the yellow line itself, we can just measure that market maker move, that $17. that gets us to a cog line, 44.32. And the other cog line is 44.11, which is shaded down there, nice and hard to see, just the way I like it. It's there, but you got to look for it. So 44.32 to the downside, we'll just steal that line and bring it up top here. And 45.50-ish to the upside. And again, this isn't even extreme yet, right? This is still just measured move. If we wanted to get extreme, we would want to double this entire thing, right? So if you take the ADR for an example, we'll just use a box since it's a little easier to see perhaps. That box is the entire ADR from top to bottom. So half of that would be ADR, it'd be 95. This is like a 2% box. If you take that box and set it up there, that would be a 4% move today. That's a pretty extreme move. The S&P has moved 4% before in a day. It can do it again. You just got to remember that half the day is already done. Now that's usually where newer traders say, what? Dude, it's not even 8 o'clock yet. How can half the day be done? It started last night at 6 o'clock. And we are past 6 o'clock now, right? So half the day is already done. You've only got until 4 o'clock. So could we move 4% between now and 4? Yeah, we could, but that would be very violent, very extreme. Wouldn't be subtle or sneaky or anything like that. So another thing that you could do to perhaps dial it down a little bit would be to do half, right? Just do the normal ATR. Take that ADR and set it on top. That would put us at about 45.80 to the upside. And to the cog line on the downside. It's not a coincidence, right, that we keep lining up on things like cog lines and gamma levels. So should things get a little wild today, up or down, we could see 45.70 or 4,400. And you know, the way I'm supposed to say it is we could see and or, right? Because we could actually see them both. If you've been around long enough, you've felt that move before, right? Where we make one big crazy move in one direction and then it flips over and makes one big crazy move in the other direction. We have been holding the range for most of the week-ish on the idea that we needed CPI. And, you know, so far that has held true. Now it just needs to finish it. We got to come out of this thing and get it done. Now, if you've done any sort of technical analysis books, candle reading, anything like that, one thing they're going to tell you is measure the range and then plot that measurement one direction or another. If we go to the downside after having plotted that range, you can see that everything that we've been measuring doesn't exactly line up perfect, but we're still in that same zone. So for anybody thinking, oh man, you're reaching, you're asking for too much. Nope. This is showing that I'm not asking for too much. We're not even getting into the extremes yet at all. So you should be pretty good at this point, pretty prepared for the day. Just keep in mind that there's no amount of technical analysis in the world that's going to give you an idea of where we're going at this point. The only thing that's going to matter is, are the institutions and the traders off sides or not? And are the numbers that we're going to get in line with estimates or not? That's it. That's the only thing that's going to move this market. So if they come in hot, that's going to move the market. And if they come in really light, that's going to move the market. Or if the consensus is one thing and they get a surprise number, either one of those two. So there really isn't any point to see what else is up this morning, what's down, all of that, because it's not going to matter. Once we get the data point, that's the only thing that's going to matter. The consensus for year over year CPI is 3.3, and the range is between 2.8 to 3.5. Here's a picture for those who need the visual. And that's a wrap. All we got to do at this point is get the numbers. Hopefully we get one of those liquidity gap candles and we get to play a gap close today. Everybody be careful, be safe, watch the clock. Remember, all day today we got things: auctions, Fed speakers, CPI, job numbers. It's going to be go, go, go all day. Everybody be careful. I'll see